The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, one bright spot on Wednesday's trade, the corn market did finish with a little bit of green on the screen, but soybeans were down double digits. Could part of that been the news of that tariff on India starting August 1st? Meantime, cattle complex just keeps churning out the wins as we saw more strength in fats and feeders on the future side Wednesday. Let's talk about things. Joining us for a conversation, Mike Zuzolo with Global Commodity Analytics. Mike, good to talk to you again this week, and we have plenty of news to go through. I think the headline, one of them to start, is the Federal Reserve left interest rates unchanged, and that might be something that catches the ire of President Trump potentially, Mike.
I think so. I mean, the CME Fed tool that I looked at last night had a 97.5% likelihood that the Fed would not do anything today. So it should not shake the earth. What we saw today that really built the dollar up again and allowed it to make a new monthly high, get close to last month's monthly high. In fact, Jesse, was a GDP figure of 3%, which is better by about 4 to 0.5% than what the trade was thinking. Estimates for economists were thinking. So the dollar bull seems to be waking up again, and that's going to be a piece of the puzzle. I think it already is in the wheat market. But getting back to the Federal Reserve, one interesting piece of indication is that the Federal Reserve had two governors dissent and vote for rate cuts, as I understand it. First time since 1993 that has happened. That will be something we'll need to watch here in the next week or so to see if that leads to Chairman Powell leaving his post early. And then does that weaken the dollar? Or how does that work in the currency markets?
Well, and that's a good point. We'll watch how that all unfolds and how that ties back into the currencies and the ag sector and more. I think the other big headline that came out late in the session Wednesday was this news of a 25% tariff on India from President Trump starting August 1st, and citing trade barriers and India-Russia relations. And I have to wonder, and I'm going to pull up our first chart. I think we can talk about it when we look at this, looking at soy meal, soy oil. We found pressure in the soy complex on the day Wednesday. Wondering if some of it was tied to that India news, Mike.
Yeah, I think so. And I think the other part of it was tied to the fact that, when I look at the China-U.S. negotiations this week and I listen to the presser by the USTR and also Secretary Treasury Bessent yesterday, it just seems to me we're kind of stuck. We haven't really moved the ball forward in any way. And President Trump has not signed off on the extension of the tariff pause. So there is an element of question because after tomorrow will be on August 1st deadline. And so I think the U.S.-China trade negotiations, I would call neutral to negative. The market, I think, had been holding a premium in the soybeans, buying beans, selling corn. But then we started off with better crop conditions, surprisingly better crop conditions in soybeans. And then we heard that China was back on for a second load of Argentine meal, and that the Argentines are really working against the U.S. and Brazil, for that matter, by slashing their export tax. And what you saw as a result of that, I think, Jesse, along with the rains coming through and kind of making us go back and think about those improving crop conditions and the bean crop being made now, is we're back to those 2016 lows within about $1, I think, $1.50 of that $255.70 major 2016 low. And then you go back before that, and you're talking about going back to the lowest level since like 2008, 2009, somewhere around there. So, I mean, it's a big deal. Meal continues to be the leader to the downside. And I think this is where the bean oil can keep trying to be the long side of spreads, but at some point you're going to make that spread too wide.
Well, and you can clearly see on this chart, meal, just that trend. It's a clear downward trending channel that's been happening really since the highs back in 22-23 timeframe here, Mike.
It is. Meal's a dog. There's just no way around it. Meal is a dog, and it goes back to, this is why, for academic purposes, this is why I watch soybeans and hogs so closely, because those two are so closely related to China in terms of where their price direction comes from, because the demand for pork and the demand for soybeans, because of their demand for pork, has been so good and so, dominant in the market. And that's why I really wanted an Indian trade deal. And I think this is indeed part of the issue when it comes to India, as far as taking more of our U.S. ag exports.
Let's talk about that in November soybean, December corn futures spread. And as we mentioned, this pressure at soy Wednesday, we broke Nov beans below $10 at the close on the board, which is not something I think anybody wants to see. December corn, on the flip side, had a small gain and held above the 410 recent lows. So, I mean, you look at this spread, what are you watching here as we work through midweek?
Jesse, I tell you, it's really interesting for me because, as you know, we've talked about fundamentally how the corn should be the best, supply demand wise, the best to hold into the bin and hold into the future on a cash basis, in my opinion. And felt like that for many, many months now. But yet the corn has been the short side of spreads, no matter how good the ethanol demand, which we had another good week of ethanol production. No matter how good the exports are, we beat the pants off the highest trade guests on the export inspections earlier this week. Crop conditions didn't go up, and we still have several issues globally with the corn crop. And so to me, this is why are the funds so short the corn and feeling so good about the beans? It had to have been the bean oil and maybe the expectation that we were going to get a China trade deal, because China not coming on board with us means next to nothing when it comes to the corn side of the equation. And so we finally are starting to see, I think, the beans give up and kind of throw in the towel. I don't want to say this is the beginning. I will talk about this in a minute, but I really want to see the corn come in here and the wheat come in here and support the beans, because to me, this ratio of 2.42 beans to corn and new crops still too high in favor of the beans. And I think I would love it to see the corn rally and the beans essentially go up half speed, but as you said, with November beans cracking 10, front end has gone right down to, if not just below, major support at 965, 970. We need to hold that going into the end of the week. Otherwise, we're probably on board for hitting that 940, 945 low from late last year and getting back into those prices that we were at when we were back in the August report. And this brings up a huge point. When it's all said and done, this week has felt so much like last year at this time heading into the August report. And I think this is where the price action is starting to look like it as well.
Let's talk a little bit about the wheat market here. Let's rope that in, and we can look at the world cash wheat prices. U.S. Gulf still remains the cheapest here, Mike. And I mean, we kind of had a mixed day on Wednesday with futures wise anyway. KC wheat was a little higher. I mean, you look at this cash market for wheat and think about support for the corn market and soybeans. I mean, what are you tracking here?
Yeah, the problem with the wheat market, once again, and this is where I really, I hate the fact that I've been right about wheat being the leader in terms of forming a bottom before the corn and beans can. But here again, we see the wheat market, even though we're pretty much through harvest, even though we've got really tough spring wheat and barley crop conditions right now compared to last year, the wheat continues to go lower. I really think it's about the Russian sanctions. When I dug deep into that Senate agriculture or that Senate bill on sanctions for Russia, after President Trump made the comment on Tuesday that he was moving up his timeline to 10 days starting from Tuesday in terms of turning on these sanctions against Russia, it suggests to me the Russian sanction bill in the Senate's going to move forward pretty quickly at this stage of the game. And so this, to me, is about the Russian sanctions don't include the wheat, and so they can still sell wheat, but they can't sell crude oil. And with that news, and also the news about the ruble breaking around 5% this past week or so, or the past couple weeks or so, as this news developed, I really think this is the funds at work, and this cash price action, this cash chart with our major competitors on there really shows it up and suggests that that's exactly what it is.
And you mentioned, barley and spring wheat conditions. I think the note I saw, we could see world barley ending stocks fall to 40 some plus year lows potentially here with the condition of that crop in Canada in particular, Mike. So, I mean, that situation in itself is not great.
No, this is getting very serious, and this is where it's almost the exact, well, it is the exact opposite of what's happening in the cattle and the beef side of the equation, is that we are trying to cut demand off at the knees, if not at the neck, in the beef side of the equation because of tariffs. And we are getting away from supply demand fundamentals. We're doing the exact opposite in the grains. We are still much tighter than we were last year at this time in the wheat when you look at the supply demand fundamentals globally, and the same with the corn. And yet we continue to break the prices lower because of the tariffs, but that's only encouraging the demand and really not acknowledging any supply problems whatsoever.
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on Market Talk. A few more things in the grains, and this is something you and I have talked about a lot as well, just the overall weather picture and how much of an influence the weather's really having on these markets, just the Northern Hemisphere in general. Talk about this chart. I know this one's interesting, and this is something that we're not just talking U.S. here, we're talking Black Sea as well, which is a topic you and I have touched on many times, Mike.
Yeah, this is an interesting graph because this, as you say, this corn drought stress index is U.S., China, and Romania, but not Ukraine. And so we are now at that red line that we're at is not only above 2024, which is the orange line, we are now up above by a little bit the 5-year range top of drought in the Northern Hemisphere. And so we've been laser focused in the trade on the U.S. corn crop and how much bigger the Brazilian corn crop is getting. But it's almost as if we're becoming asleep at the wheel. And I can tell you, Jesse, the clients and subscribers, when I download our video here today to send out on a blog post, I'll have some additional Ukrainian maps that the vast majority still show conditions worsening over there. Ukraine themselves came out earlier this week and said, we're losing probably at least 2 million tons. We're driving down our production down to 28 million. That compares to USDA at 30.5 and last year at just under 27 million. We may be on track for getting down to, if not going below last year's, depending on the next 2 weeks worth of weather. There's rains that came through, a little bit more coming through in the next 5 days. But if they come back and heat up, I think we could see a crop that's worse than last year, actually. And the other thing that I found out today, just this morning, was that even where the rains came, it's kind of been like a lot of what we've seen here in this country and even in China with their corn crop. They've gotten too much rain. They've gotten, 24 hours of rain that is a monthly total. And that's essentially what happened in Kansas City. That's what happened in Beijing. I would encourage the video listeners or video watchers to go on YouTube and look at some of the Chinese flooding around Beijing, which includes farmland. So again, just not really connecting the dots and not looking at the market in its totality. We seem to be very laser focused. And why is that? It's because the tariffs have really started to distract this market and assume that it doesn't matter about supply. The demand's just going down for the U.S.
Good thoughts. One other quick thing to look at here and look at the cash prices in Memphis, for instance, and just thinking about basis and more as we get into August and harvest around the corner and things of that nature. What are some things you're going to be watching here over the next several weeks?
I have to thank my clients and subscribers for this idea because I've had several call me. Nebraska, Western Corn Belt, bean basis 60, 65 under right now. Kentucky client, longtime client, dear friend, sent me a comment today that he's at, I think, 45 under on soybeans right now. And so it got me to thinking, if we're all talking about tariffs and how bad it is, well, where are we compared to where we were going into the August crop report last year, where we made the lows? We hit the lows in August at the Mercantile Exchange, 360-ish in corn, 940-ish in beans, and 495-ish in the soft red wheat. Where are we in Memphis, which is our major export market in the middle of the country on the Mississippi River? And we're not far. I mean, the corn is still about 25 cents premium to where it was last year at the end of July. But beans are exactly where we were last year at this time, around 1026, 1027. Soft red wheat, we're actually a dime cheaper right now than we were last year at this time on the export Memphis, Mississippi market. And so you can clearly see that we do have some discounting going on, especially in the wheat and to a lesser degree the corn. Again, I put that at the feet of the tariffs. And that's, again, why we are competitive. We've seen these wheat exports pick up. We've seen these corn exports not slow down. And so my biggest fear about, I'll put it out bluntly, my biggest fear continues to be North America when it comes to corn, whether it's ethanol with Canada or outright corn with Mexico. If we don't mess with that, I don't know what would make the corn market look negative other than these massive yield numbers that everybody's talking about.
Let's go over to the livestock sector. Cattle just continue to find that support here. Another strong futures day, Wednesday, led by fat cattle, but feeders right on their heels. As you look at things here midweek, and I know we're a couple days removed from the on feed and the inventory report, Mike. What are you watching in cattle right now?
Well, I want to be clear. I'm not trying to talk this market down, but as I said earlier, we are really going after demand right now. And I don't like markets that go up parabolically or straight up because it's a supply driven market and it really hurts our demand a lot longer after the highs have been made typically. Yes, we are in brand new territory, but we have to remember that if USDA is right, we only have 1% less all cattle this July versus last July. We only have 1% less beef cows at just under 29 million head than we had last July. So the supply domestically is not nearly as tight when it comes to keeping weights high on cheap feed as far as what we can produce here domestically. The question really becomes is where are the Mexican feeders going to come back in? We had our first death in Mexico reported from screwworm. That's likely going to send more of a shockwave into the sentiment, probably of our policymakers saying, we really got to be careful now when we open our border up. So it could elongate or lengthen how long we take in terms of opening that feeder cattle market back up, Jesse. The big news came with Brazil, though. You talked about India. I talked about China. Brazil came in the last 30 minutes, 45 minutes of the market trade. President Trump is going ahead with 40% additional tariffs. That's 50%. Brazil is saying they're going to lose about $1 billion worth of beef exports to the United States, or around 200,000 tons in the second half of this year. And they've also reported that they've started to divert already beef that was heading to the United States or going to go to the United States that were still in Brazil freezers to other countries like Mexico. I think when the market caught wind of this, it really said to them, we got to cut demand off even more. But I would caution domestically, look at the packer margins here. We're at a record low packer margin. I suspect tomorrow we may be at close to, or by the end of the week, close to negative $300 per head. What will the packer do to try and bring his margins up? That's question number one. Question number two is, we really don't have a trade deal with Japan that is in detail. We don't have a trade deal at all with South Korea. They buy about $1 billion worth of beef from us. So we could see our beef exports to Japan and South Korea suffer. I'm not saying we will, but it's a question. And so we're getting dangerous now at this point. I like the fact the cattle are going higher. I like it for the ranchers because they're not making money on those expensive feeders that they bought about, this past 30, 60, 90 days. But we're really starting to get into a demand issue here from what I remember after being around 30 years in this industry. So it's a big deal to me.
Looked like cattle maybe helped support the hog trade a little bit on Wednesday, Mike. Any thoughts over there?
I agree. We started off weaker. Hogs have been very weak. That bean corn relationship, that bean hog relationship, again, looked like China was coming in and playing a negative role with hogs. But if you were a protein, you probably got picked up because the fat cattle took off. We probably saw sympathetic buying just because you couldn't get into cattle at that point.
Mike, any other thoughts? Anything else you would reiterate to folks on the show today?
I think we've given enough today, Jesse. I just say pick up a 2-week free trial. This is a really good time. This is a historic time period to be talking and conversing back and forth and letting me know your thoughts and having a good discussion about your farm and your ranch. So please go to globalcomresearch.com, globalcom with 2 M's, research.com, and pick up a trial and start calling.
Always enjoy it. Mike Zuzolo, Global Commodity Analytics. Thanks for joining us on Market Talk. Have a great week, sir. We'll talk to you next week.
You too, Jesse. And I got to say, Jesse, thank you for all you do in getting the information and the communication out to all the farmers and ranchers. They really need you, and you do a great job.
Well, I appreciate that. And likewise, couldn't do it without great folks like you. Mike Zuzolo, Global Commodity Analytics. Good to hear from you, buddy. We'll talk to you next week.
Thanks, sir.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.